Today we're going to take a look at the new playbook for an absolute giant in the industrial world, Air Products. They've got a new CEO at the helm, and he's not just making small adjustments. He's on a mission to completely right the ship. So let's get into it.
So just who are we talking about here? Well, Air Products is a massive company. I mean, they supply the essential gases, hydrogen, oxygen, nitrogen, that are basically the lifeblood for all sorts of industries, from making electronics to processing food to producing energy. And right now, this company is at a really critical turning point. And its latest earnings report tells a pretty fascinating story of big changes on the horizon.
And you really don't have to look any further than the new CEO's own words. It just perfectly frames what's going on. This is all about course correction, getting back to what works, and really focusing on what drives value. So you have to ask, what exactly went off course in the first place?
Okay, let's jump into that. To really get a grip on where Air Products is heading, we first got to understand where it's been. And the financial results from fiscal year 2025, they're really the key to unlocking this whole story.
Now, if you just glance at these numbers for 2025, they look pretty decent, right? The company hit its targets, delivering an adjusted earnings per share over $12, a healthy margin, but, and this is a big but, notice that one little word, adjusted. The full story, well, it's a bit more complicated.
So let's just quickly break this down. Think of it this way. GAAP numbers are the full, official story, warts and all. And in 2025, the warts included a massive $3.7 billion charge for things like backing out of projects and restructuring. The adjusted numbers, on the other hand, are kind of like the highlight reel. They strip out all those big, one-time events to show you how the core business is actually performing day to day.
And since we're talking about EPS so much, what is it really? Forget the textbook definition. Just think of it as the slice of the company's profit pie that belongs to one single share of stock. It's one of the numbers investors watch most closely, and as we're about to see, growing it is priority number one for the new leadership.
Which brings us right to the new captain's plan. After looking at all the challenges, CEO Menezes laid out a super clear, three-part strategy to steer this ship forward into 2026.
And here it is, the roadmap. It's pretty straightforward. First, deliver consistent, predictable growth in that EPS number we just talked about. Second, get a much tighter handle on the company's giant, multi-billion-dollar projects. And third, be way more disciplined with how money is spent and managed. It's a real back-to-basics approach, all about focusing on the core business.
Now, you can't right a ship without trimming the sails, right? And a huge part of this new discipline means making the company leaner, more efficient, and, well, that involves some tough decisions. And the scale of this is significant. We're not talking about minor tweaks here. We're talking about a major right-sizing of the whole company. 3,600 positions have been identified for reduction. That's a huge 16% of its workforce from its recent peak. This isn't just trimming around the edges. This is a fundamental change.
And the financial impact? Just as big. Those reductions are expected to save the company $250 million every single year. That goes straight to the bottom line, adding about 90 cents per share to earnings. It's a massive lever to pull.
The CEO is also making it really clear that this isn't just about saving money for the sake of it. He's saying it's a strategic necessity. The company is planning to spend less on giant new projects, so it has to adapt the size of its organization to that new reality, all while fighting off inflation.
And speaking of those giant projects, let's shift gears and talk about the company's huge bets on the clean energy transition, because this is where you can really see the new discipline strategy in action.
First up is NEOM. This is a gigantic green hydrogen and ammonia project in Saudi Arabia. I mean, this thing is one of the most ambitious clean energy projects in the entire world, designed to use solar and wind to create fuel with zero carbon emissions.
So, under the new leadership, NEOM is a firm go. It's happening. The project is already about 90% complete, and as you can see, there's a really clear timeline to get it fully up and running by 2027. This is exactly what the new model is all about, certainty.
But now, let's look at the other side of the coin. Contrast that with another one of these mega projects, a massive blue hydrogen facility that was planned for Louisiana. This project is in a very different spot. It's on pause.
And this quote, man, this says everything about the new philosophy. FID stands for Final Investment Decision. That's the point of no return, when you commit the big billions to actually build. And the CEO's message is crystal clear.
Air Products will not give that final green light until they have legally binding offtake deals, which are just long-term contracts from customers who promise to buy the product. No more building it and hoping they will come.
Okay, so with all these changes, we've got cost-cutting, we've got project discipline, a refocus on the core business. So what does the future actually look like on paper? Let's check out the financial forecast for the year ahead.
First, let's just quickly define a term you hear a lot: capital expenditures, or CapEx. All that means is the big-ticket spending a company does. For Air Products, that means building huge new gas plants and all the infrastructure that goes with them.
So for 2026, the company's planning to spend about $4 billion on CapEx. But the really crucial thing here is the long-term trend. The goal is to bring this yearly spending way down, to around $2.5 billion once these current mega projects are done. It's all part of that capital discipline we keep talking about.
So what does it all add up to? Here's the payoff. All of these strategic moves are designed to produce real, tangible results. For fiscal 2026, the company is projecting that its adjusted earnings per share will grow by 7 to 9%. This is what riding the ship looks like on the bottom line.
All right, so when we put this all together, the whole story of this turnaround really boils down to 4 key things. First, you've got a new CEO bringing a laser focus back to the core business. Second, a major cost-cutting plan is underway to make the company leaner. Third, a new super strict discipline is being applied to those massive clean energy bets. And finally, all of this is expected to deliver solid earnings growth in the year ahead.
And that really leaves us with the big question, doesn't it? Air Products is trying to do 2 incredibly difficult things at the same time: invest in a very uncertain clean energy future while also delivering the steady, predictable profits that investors demand right now. So, with a disciplined new captain at the helm, can they actually navigate these tricky waters? We'll have to wait and see. Thanks for joining me.